Hi there, this is Matt Curfman from Richmond Brothers here with a end of the first quarter of 2022 edition of Matt's Minutes. Thank you so much for tuning in. As a reminder, my and our goal at Richmond Brothers with these videos is to help educate, help inform, help guide so that together you and us can make a team decision to help move you in the direction of your financial goals. So appreciate you tuning in to listen. So I think a phrase I hear and I see a lot in headlines in the last couple of months in financial articles, I'll call it the wall of worry. And just there's a lot of concern out there, which is leading to volatility in lots of different market circumstances. We did end the quarter on a negative note from a broad perspective. If you look at broad benchmarks like the Dow Jones, the S&P 500, the NASDAQ, even AGG, which is kind of a benchmark for the core bond market, anywhere between down 4.5% and down just over 9%. There was a period though in mid-March where the one of the larger indexes, the NASDAQ, for example, almost hit minus 20%. So it's gone from starting down 20% roughly and then back up to -9 is the NASDAQ, just to kind of give you a sense of what we're seeing. So what's happening and what does a wall of worry mean? Well, wall of worry, say that 3 times fast, is that there's a lot of things with the Federal Reserve and short-term interest rates. They've been near zero for a long time, and that impacts things like if you had a mortgage and you were going to buy a house. Mortgage rates have been historically very low for a long time. We're starting to see that go up as the Federal Reserve starts that increasing policy, which they did in March of 2022. It's very likely they'll continue that policy throughout the rest of the year. Then on top of that, we have inflation. Mostly we're seeing cost of fuel, cost of food go up quite a bit. So that eats into our weekly or monthly budgets and makes it hard to manage, and your money doesn't go as far. And that's where inflation can hurt. So one of the Federal Reserve's goals is to raise the short-term rate to help combat inflation and manage the overall money supply. It is possible that as rates go up, one of the things that we as consumers feel the most is we look at mortgage interest rates or borrowing or lending rates, and those will probably go up. So the higher that rate is, the less apt we are to then go buy a home and take on a new mortgage or borrow money to go purchase something. Generally, though, the Federal Reserve historically is raising that short-term rate for 2 reasons. One, underlying economic conditions are actually improving, and 2, to help manage against inflation, which we just talked about that we're all experiencing. As if that weren't enough, there are still global supply chain issues coming out of the pandemic as the world tries to figure out what our new normal is. And then on top of that, we had geopolitical concerns, and I'm sure many of you already know what I'm going to say, but it has to do with the conflict with Russia and Ukraine and kind of the fear and the uncertainty that can come with those circumstances. And so it raises that fear index in the markets and adds to that wall of worry. Another phrase I'm seeing out there quite a bit right now with respect to interest rates is yield curve inversion. And so I'll give you kind of a short Cliff Notes version of what that means. If you were to compare a 2-year interest rate, let's say you went to your bank to buy a 2-year CD, and you also quoted a 10-year CD, generally speaking, the longer you're willing to give up in time, the higher interest rate you'll be able to earn in a safe asset. But an inversion is really the opposite. You start to see 2, 3, 4-year treasuries, maybe with higher payouts than 10-year treasuries. Usually that's not a circumstance that stays around very long, but also historically that could be, and I hate to use this word, a future signal for recession. Those are lots of headlines that are out there now that you're seeing if you're paying attention. We just want to kind of take a step back from that and not add to that fear factor. These signs are way too soon and way too premature. And really, we're looking out a couple of years under those circumstances historically. So there's so much going on right now. I think we pay attention more to the present and what we anticipate this year than adding to that wall of worry. So again, historically, and for those of you watching, you see that my dog Cooper just joined me in the background. He loves getting on the Matt's Minutes videos, in case you haven't seen that before. Historically speaking, whenever the Federal Reserve goes through a increasing interest rate cycle, 100% of the time, historically, the best class of assets to own during that period is equities, which is really the market stuff, the stuff that's dipped. Second, anytime historically we move into a higher than normal inflation period, which we are now, if you look out over the next year or two, one of the best asset classes to own is also equities. So I give you that context so that if you are a little nervous, a little anxious, that's okay. Talk to us, talk to your advisor. And we want to kind of keep coming back to the language of what is your risk score and what's your risk tolerance. We use a wonderful tool that helps us communicate that with you. And if you remember, the scale of risk is 1 to 99. The closer you're at a 1, the more conservative and the more stable your portfolio is. The closer you are to 99, the more aggressive and the more volatile your portfolio could be. Now, over a long period of time, you hope that the higher risk you take, you have the ability to achieve higher returns. There's no right or wrong answer. There's no number you should have based on your age. It needs to work for you. And then we can help guide from an investment strategy to solve for that towards your goals. So this video is getting a little longer than I'd like, but I just wanted to kind of let you know what we're seeing out there. We do anticipate interest rates continuing to go up. Inflation is still here for the near term. And we are not out of the woods yet with geopolitical conflicts with Russia and Ukraine. So that will likely continue to add to the choppiness that we're experiencing in the broad benchmark. So if you have any questions or any concerns, as always, just call us or email us directly at questions@richmondbrothers.com. Thank you so much for tuning in, and thank you for being part of our Richmond Brothers family. We are grateful for you.